Would you like an opinion on a financial matter you're dealing with? Whether it's about retirement, investments, taxes, or 401ks, Scott Hansen and Pat McClain would like to help you by answering your call. To join Allworth's Money Matters, call now at 833-99-WORTH. That's 833-99-WORTH.
Welcome to Allworth's Money Matters. I'm Scott Hansen.
I'm Pat McClain. Thanks for joining us.
That's right. Glad to have you with us, both myself and my co-host here. We're both financial advisors, certified financial planner, chartered financial consultant. We spend a lot of our days helping people with their futures, financial futures. And we are come here on broadcast on the weekends to be your financial advisors on the air.
Yes, and 30 years. Really enjoy it. Has it been 30 years? It's always based on the age of your daughter for some reason.
We've been 29 years. We've been doing the show 29 years.
And I think it's because we just started the show right before she was born.
She was. Well, I remember because I don't know how many listened 29 years ago, but it wasn't a very good show.
Oh, it was,
we tried.
Well, maybe it's not either today.
Maybe it's not. But I remember our first. I don't know. It was Christmas time in the year. My daughter was born on Christmas Eve, so I wasn't working a couple days around. And it's Christmas. I normally don't work Christmas anyway. But you interviewed Santa Claus for the financial planning.
That's right.
That was kind of our producer at the time. Thought it would be a good little. He was one of like those morning guys that would call and prank people and stuff like that. And so I think we've progressed a bit since then.
Fortunately, we don't have tape of that.
Pat's not interviewing Santa Claus on his financial planning needs. What it costs to run the sleigh or whatever it was. I have no idea.
How embarrassing.
Anyway, we enjoy coming here and talking about the financial markets, and would love to take your calls if you want to join us. Questions@moneymatters.com is a good way to reach out to us and schedule a time, or you can call 833-99-WORTH. But before we go to the calls, the markets, the Magnificent Seven, essentially 7 large tech stocks,
turned into the fumbling 5.
Okay, there was roughly on Wednesday almost $1 trillion of valuation of decline just off those 7 companies.
Yes,
almost $1 trillion, massive.
Yes,
Wednesday was a pretty significant decline on the Nasdaq, but it was primarily those 7 companies. And if you look at, say, the S&P 500 up until a couple weeks ago, almost all the gains came from those companies. And if you've noticed, like in the last week or two, when we're starting to see these Magnificent Seven,
they're starting to fall apart.
Well, they're coming down a lot in price, but we're seeing other areas of the market, these other stocks that have gone nowhere
for some time.
For some time.
Yeah.
And like small caps, all of a sudden.
Which, again, at any one point in time, you should be unhappy with about
some piece of your portfolio. That's right.
Again, probably about 20 to 30% of the portfolio you should be unhappy with at any point in time.
And I tell you, the danger for individual investors is people monitor their portfolio as they're told they're supposed to, right? Check things on. Let's say you're doing it yourself and you're checking it on a quarterly basis. Those areas of the market that have not performed well that current quarter are going to be inside some piece of the portfolio that you own. Maybe it's an ETF, maybe it's an actively managed mutual fund. And if let's say you have a mutual fund that specializes in companies outside the Magnificent Seven, right? That's what they're designed to do. Well, during periods of time when those kind of securities are out of favor, it's going to look like you own something that's a dog.
Yes, and if you think about growth versus value for years and years and years, how growth outperformed value investments.
When historically that
isn't the case.
If you go back long enough. So it's
it's a reminder. But Scott, in saying that, I came across an article that talked about how much cash is in IRAs from people that move their 401ks over. They roll their 401k over, and for whatever reason, it cash heavy. Cash heavy. And
These rolled into IRAs or
they're
rolled
rolled into IRAs.
That's because the default is cash.
That's because the default is cash. So
If you open up an account at Schwab or Fidelity or Vanguard, a brokerage account, and you transfer a 401k plan into that, it's going to drop into a interest-bearing account until you make an instruction
to invest it.
Yes.
And by the way, little secret. What is the best returning asset for a custodian that is actually putting money? If someone put money into your IRA and you're a custodian, where would you want the money to be?
If your number one concern is your own profit,
that's right.
You want to leave it in cash.
And why?
Because you make a spread.
You make a spread.
Just
on
the same thing when you look at your checking account, they're paying you 0.001%. And the bank can earn 5%.
That's the spread.
That's the spread.
And the custodians, it's the same thing. You've dropped money into the account. So the numbers were it was mind-boggling. The amount of time money sits in cash before people invest it, or if they invested at all. And you're not seeing a nudge from the custodians, Charles Schwab, when we talk about their IRA custodians. Charles Schwab, Fidelity,
Vanguard, the big ones.
There isn't a huge nudge to move those dollars forward in some circumstances, and typically smaller.
Well, from a
account
financial
balance.
standpoint, you're taking them out of cash and investing in some very low cost ETF index fund. It goes backwards for them financially.
And where this happens is on the smaller account balances. If you roll $1 million in IRA over to Fidelity and keep it in cash, you're going to get a phone call. But if you roll $30,000 over,
well, because they know that it's probably it's not going to stay unless
it's not going to stay there. It's not going to stay in cash. But it was perplexing to me. And these are smaller account balances that actually need it most. Oh, and there's other firms out there, the custodian firms, that specialize in essentially. Your daughter had one. My son has one. My son has one, and he was.
My son worked for Best Buy in high school.
For how long?
Selling a year and a half or so.
Okay.
Selling home entertainment systems.
Okay. And he left his 401k behind.
Yeah, he had a small 401k, and there's I forget the name of the company now. There's a company that specializes in taking small 401k balances, because the rules are if it's small enough, the employer can just say, hey, send the dollars to an IRA. So that automatically an IRA is set up in his name, and he gets a little notification saying, hey, we've got money here for you. What would you like us to do?
That's right. That's right. And most people
don't do anything.
Don't do anything. Most people do not do anything.
Which is why there's how much money sitting in cash in these old 401k? I saw the headline of the article. I'm like, I know exactly why that happens.
It was a lot. It was a lot.
I mean, one of the things, if you work with an independent financial advisor, a firm like Allworth, there's other good firms that are also independent. When you hire an advisor on a fee base, you're paying an asset management fee for advice. That advisor, it's not going to be conflicted like the big Wall Street firms where, hey, if we just keep some money in cash, we're going to earn more money.
That's right.
They'll put it somewhere. Whether it's in cash or in the Magnificent Seven or in ETFs or no-load funds or growth funds or value funds, it makes no difference.
So Scott, this is what really is. The older you are, the less amount of times you actually leave money in cash after 1 year. So if you're 60 or older and you've got money in cash, after 1 year, those 25% of those people that started in cash have it in cash. If you're 20 to 29, read your son here, it's about 60%. And those are the people that actually should.
Oh my gosh.
It's exactly the opposite. Those are the people that should have 100% of their dollars fully invested in equities.
Correct. They're in their 20s.
The smaller accounts.
Even if you take a small balance, what it can mean between 25 and 65 is tremendous.
Yes.
Between leave it in cash and have it invested.
Correct. So, anyway.
But people do need to take responsibility for their own futures.
You've got to own it.
I mean, this isn't a socialist country yet. Yeah. Okay. I mean, people have. You need to take responsibility for your finances.
Yes.
If you don't, I guess you have Social Security to rely upon.
No
There was
comment.
also an article in this last week on the number of people hitting retirement age with absolutely nothing,
You saw it.
and it's heartbreaking because there's no when you're in your end of your career and you don't have the. I mean, you're.
The assumption is those are not our listeners.
No, I understand that.
Although they should be concerned about it because it puts more pressure on social services.
Our listeners should be concerned.
Yes.
Well, we should all be concerned when people aren't saving and investing and taking responsibility for the finances.
Yes. It puts more pressure on social services.
Yeah, and yeah.
Hey, so before we go to these calls, Canada cut their interest rate this last week.
Yes.
The U.S.
twice in a row.
Yes.
Not twice last week. I mean, meeting after meeting.
I just find it really interesting how slow the Fed's moving on this. Not that it's good or bad. Comments? Just cautious.
Well, I mean, we just saw the economy grew, 2.6% preliminary estimates last quarter?
Yeah.
Pretty nice growth.
Yes.
I mean, it's not 4.6.
Yeah. Yeah. So maybe there's.
But, I mean, if you look at the last 15 years, that's almost been a decent growth rate, right?
Yes.
So economy's growing. Employment is still relatively robust.
Yes.
Low unemployment numbers.
Political environment's stable.
Very stable. There's been almost no news. I was thinking the other day, like I've been threatening to do a news fast, just going like a month or 2 months of no news.
How could you do that? Do you think you could do that?
I've heard of people doing it. Just tune it all out. But I thought, if you miss the last 5 weeks, I mean, the most interesting times in U.S. politics in our lifetimes.
Yes.
The last,
and this is all we got. And this is all we got. That's what when I talk to people on either side.
Of course, 90% of people really?
This is it. This is what. All right, let's go to the
Pat,
calls.
Maybe you should run for president. I think it's not too late to be the nominee. Just get chosen somehow. Anyway.
Oh, could you imagine a worse job? The stress. The Air Force One is intriguing.
The perks. Yeah, I'd kind of like for everyone to stand and them to play a certain song for me every time I walk in the room.
Yeah. The retirement seemed pretty comfortable.
Yeah, you get to fly wherever, and you got all this security around you, and
turn out a book,
pay you a fortune to go speak.
Turn out a book or two.
I think this current president, his retirement is going to look a little different than other.
Yes.
I don't think he's going to get paid to be on the speaking circuit. No. Anyway, we don't want to talk about that.
Let's go.
Let's go to the calls here. Again, if you want to be part of Allworth's Money Matters, send us an email at questions@moneymatters.com. We're talking with Angela. Hi, Angela. You're with Allworth's Money Matters.
Hi, how are you today?
We're great.
Well, you were talking about Santa Claus earlier, and it really made me think about my grandma and the situation I'm in.
Okay.
Well, I've recently taken over conservatorship for my grandma, which means she's still alive, but she didn't have a will or a trust or anything put in place, and then she got diagnosed with dementia. So I've had to step up and get a court order to say that I'm the person in charge of her and her assets.
What was that process like?
Oh, it was I felt like I was on the stand.
Yes.
You know? I had to prove myself as a worthy person to step up to the plate to take care of her.
Did anyone contest it?
No, there's no family left to really contest it. And there's my grandfather's passed, my father's passed, my aunt has passed, so I'm the granddaughter. I'm the only one that can really step up, and it was either me or, turn her over to the state, which I wasn't going to. That happened to my grandma.
Yeah, a court-appointed trustee.
And did you have to hire an attorney to get this conservatorship?
Yes, I did. Because at first, my grandma, because of her dementia, she was really fighting it. Like, you don't get to tell me what to do, and you don't know what you're doing. So I had to get all of the medical reports from the psychologist, from the doctor saying, she can't, she's hallucinating, she's just not capable of making rash decisions. She's up in the middle of the night. She was going downhill really fast, and so they needed.
Angela?
Uh-huh.
Thank you for this call. For all of you that are listening,
I wanted her to tell the story a bit because
everyone that is listening, this could have been avoided when your grandmother, and you know this, Angela, just the rest of the listeners, could have been avoided when your grandmother was of sound mind if she had just done some simple either trust or power of attorney.
A trust having you as the successor trustee.
Yes. So you're the only beneficiary to this estate. Is that correct?
No.
How many beneficiaries?
No, that's where it gets tricky.
Okay.
So I am now put in control of $2 million. That's how much money my grandma has. And she spread it out between 6 different banks. And through those banks, there are 15 different CDs, 3 checking accounts, and a savings account. And all of them have different paid-on-death beneficiaries. Some of them have multiple on one account. And part of the conservatorship is written in that I must honor all of those paid-on-death beneficiaries. But come on, I don't have time to go around to 6 different banks and handle all these CDs every time they come due. I'm a normal working person.
Well, Angela, many financial institutions now have programs where you can have one account and the CDs get, when you exceed a certain limit, they'll invest it in a different bank CD.
Understand, she has to honor the POD.
I understand that. But one way to do that is just to calculate out what percentage of this $2 million each person is going to receive, set up one account.
That's right.
And have the beneficiary. So instead of someone's supposed to get 50% of this $100,000 CD, now they're getting 2% of, or whatever, 2.5% of the overall portfolio.
And so as long as you could calculate it.
Yeah. Oh, yeah, I put it on the spreadsheet. I completely have all of those.
Okay, so what's your question for us then?
So my question is, though, is that the best way to do it? I want to take all of this money out of all these different places and put it into one place.
That's correct.
Yes.
And somehow honor these paid-on-death beneficiaries. Some of them are like to her neighbors and friends who helped take care of her to keep her at home for so long. So she is 96. And this all just happened around Christmas time. So I'm supposed to honor all of those. So do you think that I can liquidate all of that and reinvest it with that percentage that you were talking about?
100%.
Okay.
I mean, it's just calculating what percentage of the overall. I mean, you can go about it one of 2 ways. One is calculate it based on a dollar amount today, how much each person's supposed to get dollar amount, then back into what percentage that is of the total dollar amount, or you can just do it as a percentage, calculate it percentage-wise.
Is it? Yes.
But you can certainly have it. And
it would be, do they all have PODs on them?
Each one of them does have a POD on them, but some of them have 2, and there's one that has 3.
Okay, well that's easy. It's simple math. I like the idea, Scott, of keeping a spreadsheet, calculating. Take all those numbers, right?
And let's say there's 12 beneficiaries,
right? And then each percentage, and it adds up to 100, and so that at time of death, you know exactly what percentage of whatever the remaining account is. And then
you can set it all up in a POD in one account.
And then go to a local, where are you located?
I'm located in the Sacramento area.
Oh, I would call, here's what I would do. If you were my neighbor, I'd say, Angela, call 5 Star Bank. It's a local bank. It's locally, was locally owned. It's publicly traded now. And ask them about their CD diversification program, and then sit down with them and show them what you want to do, and then they will actually manage those CDs for you.
Yeah.
And so what they do is in order to get the FDIC, they actually, you give them the $2 million, and you're like, oh, it's over the $2 million limit,
$250
or $250 limit, and they just like send it to Great Northern Bank or Bank of Wisconsin or Florida Bank, and they all turn it back and forth so that you get the FDIC, which pretty much negates the idea of FDIC completely, but it negates that FDIC going over the limit, and then you run the spreadsheet, and that's what I would do. And I'd call them, you need a trusted bank, a trusted institution, and look, you can go to a Wells Fargo or you could go to any of those other firms, big banks. They may or may not take an interest in you, but local banks, I mean, there is a big need for local banks in the economy, especially for businesses. That's what I would do. I would just call Five Star Bank.
Okay.
And that's...
And you think that this is a better decision than, I mean, let's be honest, because like I said, when you mentioned Santa Claus, I was thinking, well, you know, I'm due to inherit a good portion of this. And let's be realistic, you know. I know that I will be. And so how do I maximize that dollar amount? Because I'm pretty sure Grandma's she's in a very good place. I have her in a wonderful home. She's being cared for, and she's almost even thriving now, if you can imagine that, for a 96-year-old. And so, you know, Grandma could live another 7-8 years. I mean, she never smoked, she never drank, she never ate a lot of meat. She's in a really good place right now. She's great health. So, you know, should I invest and try to maximize?
Well, you have a fiduciary responsibility to act in your grandmother's best interest first and foremost.
Correct. So maximizing the money for her, should she need it, of course it's hers. It's hers for, you know.
That's right.
First and foremost. Yes.
You could make an argument that 25 or 30% of the portfolio would be in equities.
Has your grandmother ever invested in anything outside of CDs?
No, but I don't think she knew how to.
I mean, here's the risk. You invest somewhere else, right? Like, let's say you take a portion of these dollars, you invest it somewhere else. Grandmother doesn't make it 8 years. She makes it 8 months. The market's down at the time. And some other beneficiaries say, wait, well, this thing has declined in value.
But I think you could separate that, Scott, because let's say that the payment on
how much of all this are you set to inherit?
A little over half.
Yeah, so you could bifurcate those. You could keep those bank CDs on there. It's just an accounting.
Could I keep the CDs for all the neighbors and friends?
That's right.
You certainly could.
Yes, absolutely. I don't know how the court would feel about it. I don't know if we're qualified to answer the question.
This is actually, this is getting into legal advice.
This is legal advice.
We're not attorneys. If it were me, I wouldn't do it.
Okay.
Oh, if it were me, I would do it. I would take $500,000. Remember, because we're investing on Angela's time frame.
Well, when Grandma has financial needs, it's important that it's all pro rata to the exact percentages of how things are today.
It wouldn't be. It wouldn't be. This is why we need an attorney.
Well, here's the challenge. So Angela takes $500,000, let's say, invested somewhere. It fluctuates in value. Grandma needs more money for the care that she's got right now. Money is pulled out of some various accounts.
It's an accounting issue. That's right. Okay, I'm with you, Scott.
And so suddenly it's 6 years down the road, Grandma dies, and one of the beneficiaries says, hey, wait a minute. You were not contributing equally to this because you invested
to the benefit of yourself.
Yeah.
Or
that's the risk you run into.
Benefit.
That's the risk is with one of these other beneficiaries coming back to you and saying you did not act in a fiduciary manner to Grandma number one and to the beneficiaries number two. That's the risk you run into in some.
That's right.
Okay.
I'd run it by an attorney.
Well, the attorney has what she has told me to do. So I had to get the exact amounts of the accounts on the exact day that I took conservatorship. So then I have the inventory. And so she was going to have me invest these through like Charles Schwab using my financial advisor and keep each account as is. So if there's 4 different beneficiaries of neighbor and friends, there'll be 4 different accounts in there, and keep every paid on death beneficiary as is.
Sounds.
And so like one that just have my name, I would do that one as a separate account.
And
one
then
that
what
has-
happens when we need addition? What income is paying for your grandmother's care?
There is a checking account that I would be the beneficiary on, but that's her working checking account, and that one I've turned into a conservator account, and that's the one I'll be working on.
How much is in it?
$250,000.
How much is the care?
Plus she gets railroad retirement.
Yeah. How much is the care a year?
$5,300 a month.
That's actually not bad.
Yeah, it's a wonderful place too. It's beautiful, and there's only 5 residents, so she gets eyes on her all the time.
Yeah.
So what do you think of investing each one exactly as is? So if there's a total of,
And how would it be invested?
through like really safe like money market accounts, or
Okay.
like some of the really safer accounts, so that I'm not completely being I don't want to.
And how are you going to
obviously,
treat the other beneficiary accounts?
the same way? Take them all. So
Well,
if
then
there's one-
then we just said the same thing.
Have
that
one
we-
account then,
yeah, just have one account. I would just do it at a local bank.
but do it at a local bank.
Yeah, I would just do it at a local bank.
And if I were acting as conservatorship and there were other beneficiaries, I would take the path that had the least amount of risk for me.
Yeah, what you need to worry about is
Litigation.
Is litigation.
Yeah. Talk to an estate attorney who specializes in litigation.
Okay.
And
And
I
they-
mean, I know an attorney who does.
I do.
It's one of my neighbor. That's what he specializes in.
Estate litigation.
Yes.
Estate litigation.
When beneficiaries are fighting one another.
I agree with Scott. I would just bring it to a local bank and not get too fancy
I
with
would
it.
too. I really
I
would.
wouldn't take the risk. She's 96. She's 96.
All right,
Well,
Angela.
listen, a cautionary note for I got to tell you how many clients I've had over the years that I've asked and asked and asked, and they don't do a trust until it's imminent.
Oh.
So appreciate the call, Angela.
Yeah, and fortunately, I mean, she's 96. Sometimes it happened. I had a friend who was 55, 54 when he had Alzheimer's kicked in, and died
Oh.
at 57 or 8.
Oh.
Yeah,
Oh.
rare, obviously, but I mean, having some documents in place to spare, and frankly, even if a trust was set up, she's still going to have to deal with these kind of thorny issues.
It's just easier.
Oh,
Infinitely.
Yes, infinitely easier. Yes, that's for sure. All right, let's continue on here.
I don't know if it's infinitely easier.
All right, it's
That's an exaggeration.
it didn't take all of her time.
It didn't take infinity.
That's right. It probably felt that way. Let's talk with Joan. Joan, you're with Allworth's Money Matters.
Hi, how
Hi, Joan.
are you?
We're fantastic.
Great. Well, I have a question about I'm 82 years old, and I'm wondering how much money I should have in mutual funds and how much I should keep more liquid at this age. What kind of mutual funds I should have, whether I should have equity or growth or what's going on.
And do you have a financial advisor you've been working with, or you've been doing things on your own, or how's this?
No, mostly I've been doing things on my own.
And how much money are we talking about?
Well, total of my husband and myself, a little over $400,000.
And have you ever owned any mutual funds or those
Yes,
types of?
I've got about 91,000 invested in mutuals right now.
And what kind?
Well, diversified. All I have is a bunch of ticker symbols. So.
And
I have a Wells Fargo Tech. I have a Vanguard.
and how have you picked all these?
That's a good question. Well, the Invesco fund I've had since the 90s. That was my first one, but it's changed hands several times. So,
And is this 91,000 mutual funds? Is it held inside of a retirement account, an IRA, or is it on the?
no, I have a separate IRA.
Okay, so it's in a brokerage account. And
Yeah.
what the income that's coming into the family now? Where's that income coming from?
That's my husband's teacher's retirement.
Okay.
But he's 92 and he's not doing very well, so that's the variable.
And do you have?
I won't really have an income other than a very small Social Security.
So when he elected his pension option, did he take a survivor benefit on it?
No.
He took a single life only.
Yes.
And is there any whole life insurance or something like that to replace that pension, or no?
Well, I have a whole life policy. Yes, $61,500
On him.
Yes.
And is your home paid off?
It is, but that's odd because it's a third marriage for both of us, and his kids get the house. I can live here as long as
So you have
until I die, if I choose to. But it's a lot of property for me, and it's in a fire area, and
your insurance premiums are going
not
up.
a place. Pardon?
And your insurance premiums are going up.
Oh yes. And it's a whole acre to take care of.
And he's 92.
Yes.
I got to tell you, I think that I wouldn't put any more money in equities. I would be very, very comfortable with where you're at today.
Okay.
Yeah, I think the planning really needs to be when your husband passes, what's life look like for Joan? Right? So you're already looking where you're living now thinking, I don't think I can take care of this property, nor do I want to take care of this property. But what you've got going for you is essentially free rent while you're there, assuming that there's a trust set up that states that, versus leaving that place and living somewhere else. And then how do we pay for that? Do we use a reverse mortgage and do use that for a purchase? An original purchase using a reverse mortgage for half the balance of the.
I wouldn't, and I can't do that legally.
Oh no, correct. You can't do it on the existing home, but you could do it on a new purchase. So, how much income comes into the household today?
Let me see.
Approximately.
Probably about $3,500 at tops.
And if your husband were to pass away, how much income would be coming into the household?
Under $500, unless I set up an income from all my funds.
Okay, yeah, I'm calculating that as we speak. Yeah,
and I take back the reverse mortgage. You're going to need more income personally.
Yes, it wouldn't work. So you should expect that you're probably going to stay in that house till your dying day. Just financially.
You might be better off hiring a caretaker a day a week or whatever it is to do. That might be a lot less expensive than you paying rent somewhere.
So I would plan on that, and then I would keep that 75% of the portfolio, approximately 78% of the portfolio, in cash today, because we don't know whether you're going to need that money tomorrow or next year or the year after that. And what we don't want to do is to take any more of your portfolio and put it at risk. And so when we talk about risk, there's short-term risk, there's long-term risk, right? And the markets go up and they go down. They
certainly do.
Right? And we don't know whether you're going to need the money, income off this tomorrow or in 2 years from now. And since that's an unknown, to put risk on this portfolio would be dangerous. And first of all,
from an emotional standpoint, I mean, your husband passes away at the same time the markets are down. I mean, that.
Yeah. And where do you have the cash invested?
The cash is in a high yield savings, and
perfect.
I have a CD, a large CD coming due in October.
Perfect.
Maturing in October.
Perfect. So the expectation is that you're going to want to stay in that house as long as you possibly can.
I agree with Pat, and because it's free rent. So if there's some additional cost to maintain it, that cost, even on a monthly basis, may be substantially less than you trying to pay rent somewhere.
I think so. Yeah.
Yeah.
All righty.
Okay. Yeah, that
All right.
sounds great.
All right. Appreciate the call, Joe.
All right, Joan.
Thank you.
Well, wish you well.
Bye.
Yes. Yeah, that's
Wow.
tricky. Well, I mean, fortunately, she's got
A life estate.
a life estate to stay in the house and some of her own savings.
Yes. Yeah.
Otherwise, there's
I was wondering why he didn't take why he took a single life only on his pension, but
well, Pat, a lot of in the teachers' realm, it's crazy. We'll go back to culture in a second, but in public school teachers, they have, instead of a 401k, most districts have what's called a 403b, and with a 403b, the individual owns the retirement plan, not the employer. So, like if you work for a large company, you have a 401k plan. The employer sets it up, is responsible for managing it. It's in a separate trust. Money's taken out of your paycheck. Simple. As a teacher, you can invest in a variety of different things. And oftentimes, these school districts allow these salespeople to come in, financial advisors. Some are probably really good financial advisors. Some aren't such great financial advisors. They're salespeople. And they come in and sell someone on getting their 403b set up. But what they also sell is what's called pension maximization.
do you think that was it? It might have been.
He had a whole life policy.
Okay, keep talking, Scott.
So,
Explain pension max to
what
us.
it is, and says, look, you're going to retire. Your pension is going to be $2,000 a month, but if you want to protect your spouse, you're going to have to take a reduction. So instead of $2,000, it's $1,800 a month. So instead of doing that, take the $2,000 a month, the full amount. Don't have anything go to your spouse, no survivor benefit. But then we can buy a life insurance policy for $175 a month, which is less than the $200 reduction you were going to have. So why don't we do this and set this thing up?
And they call it pension max.
Pension maximization.
I've never seen it work. I've seen it tried. I've sat down with many people that had done that
exactly
after
right.
they took the pension.
And that would be my suspect. That's what happened here because he has a whole life insurance of 61. How many 91-year-olds have a whole? 92-year-olds have a whole life policy still.
All right. Good enough.
And the only reason you would need that if it's going to replace an income stream, but that 61,000 is not going to go very far.
Not far at all.
Not replacing that pension.
Yes. Stay away from these pension max schemes, as they are called.
I've never seen them work.
I've
sat aside with widows trying to figure out how we're going to.
Where if they had selected
I picture a woman. I'm gonna call her Judy. Her husband died. They were sold as pension maximization. The life insurance wasn't nearly enough. She sold her house and bought a mobile home. And we were still I was still concerned about how she was going to make it all work. This was years ago.
Not good.
No.
By the way, so I sat down with people that are trying to make this decision about what pension option to select. So you normally get, there could be 2, 3, 10 different options. You get a single life. If you're getting a pension, you could get what's called a joint and survivor, where you take 80%. They provide income to your surviving spouse for the rest of their life.
Joint and 50.
Or the joint and 50, all these calculations with pop-up provisions. As I explained it just last week, it doesn't matter to the plan, the pension administrator, which one you take. It is all the same net present value to them.
Based upon a population that is not medically underwritten.
Okay, so that's where it comes into play, which is that it's not medically underwritten.
Like a life insurance policy would be today.
So what it means is if you have a shortened life expectancy, it may drive your decision versus if you have you believe you have a normal or a above normal life expectancy.
Yeah, if you have terminal cancer and you have 3 months to live, you're going to take the maximum survivor benefit.
Yes, or a lump sum if they have it.
Yes. And conversely, if you're the healthiest person ever,
to live, and your parents live to be 108,
and your spouse is ill,
then
you might choose something different. All right, let's continue on with calls here. We're talking to Larry. Larry, you're with Allworth Money Matters.
Hello.
Hey, Larry.
Fantastic. My name is Larry, as you know, and I just got a couple of things. So we're trying to consider. I've retired. I retired in September of last year. Kind of, we planned to retire, but it kind of happened sooner than I thought. So I have.
How did that happen? Because statistically, like 1 out of 2 people retire earlier than they'd planned. What was your situation? I mean, that's just what happens.
Well, my situation was I had left my first job because I needed to leave. I had 37 years with one company, so I really could take a pension. And so I took a pension because I needed to take my mother on in my house, and in fact, I needed to purchase a larger house to accommodate her. So I took on a second job, and so money was good. So I actually made more money at the second job than I did at the first. Plus, I had the pension coming, and we're doing the dance. And then the workload became difficult to manage, and watch my mother, as she's staying with us in the house. And so we decided that we could retire, and of course minimize the cash flow, but that we could retire and get done what we needed to get done with my mother.
Yeah, well, bless you
Very
for
nice.
taking care of your mother.
So I was 64 at the time. Now I'm 65. I just became 65 this month. But it left me with was 401k accumulations in both the newest job and the job I retired from.
Mm-hmm.
Not just 401k, but also we had some IRA money as well.
Okay.
And so I've been told that I need to combine the two 401ks, and we're talking about $45,000 from one account and $180,000 from another. That I need to combine those two and then do some type of investment strategy with that. Even, in other words, take the 401k, get rid of it, and do something else.
How much do you have in these? You mentioned other IRAs. How much do you have in the other IRAs?
So I have 120 in one IRA, and my wife is still working, and she has accumulations in her 401k through Vanguard as well.
You don't have to do anything.
Yeah. Who told you had to?
Yeah, so maybe it was one of those financial advisors.
Salespeople,
You
don't have. So you don't have to do. You don't. Yeah.
You don't have to do anything. Now, in saying that.
my thinking.
And saying you don't have to do anything.
It might be more convenient for you to have all these in one IRA.
I could tell you what I would do is I would combine them all into a single IRA just for convenience.
And easier to manage.
Much easier to manage.
And you can set up a monthly income if need be.
Yeah, and you name your beneficiaries, it just makes it cleaner. Now, in saying all that, that's what I would do, but you don't have to do anything. And then I would put an investment thesis together and then operate the portfolio based on that thesis. And when I say the thesis, it's like, when do I need income? How much income do I think I'm going to need? How much exposure do I want to equities or real estate or bonds and cash? And then I would build a portfolio around it.
Okay.
So I would put them all together, and now you have an account with approximately $345,000 in it, and build the portfolio. The person that said you needed to do this, right? You needed to do this. Where were they from?
They were independent. And I've had a couple just before I left the company, before I actually left on the retirement date. I spoke with someone, and they were from and I can't remember the company's name, but it was an investment firm on the East Coast. But the other two guys who talked to me about it, they were independent investors, and of course they had accounts at both Fidelity and Vanguard, which were annuity accounts, by the way.
Okay. All right. Well, that's you don't want to do that. So don't talk
do not
to those
buy
guys.
an annuity. You
don't need an annuity. It's additional cost. There's restrictions. It's just there is a place for annuities in this world, but not for you.
Now, you mentioned just now monthly, determine, set up my plan and determine when I'm going to need monthly income and let that kind of help me. So what type of account would give me monthly income?
Well, any kind of an account would give you monthly income. The question is how much and when. So,
how old is your mother?
She's 91.
And what's her health like?
Oh, she's there. Everyone's always amazed that she is so healthy.
How old was your father
Her
when he?
brother's 102.
Oh,
okay.
My dad passed at 70. I think he was 77. So he passed. I think it was probably 13 years ago.
Are you taking Social Security?
I started taking Social Security early, but I started taking it, yes, when I retired.
And does your mother have any assets or any income?
She does. So she has a home, not in this state, but in another state, and I actually rent it out to someone. And of course, she gets my father's retirement as well as Social Security.
And so are you doing fine without having to take any money from your 401ks?
I am. I actually am at this point, yes.
When your wife retires, will you be doing fine without having to take money from the 401k?
So my wife will be 62 this year. Oh, sorry, next year. And if she retires this year, because she's wanting to do her own business and that, but if she retires this year or leaves the company, we should be, fine for a year and a half to two, depending, of course, on how the economy moves, right? So yeah, I think I can be fine, because then we'll take Social Security. We'll take her Social Security early too.
All right, and
is your home paid off?
No, so I had to buy. It would have been, but I had to buy a bigger house to accommodate my mother. I have a 5-bedroom house.
You need a financial.
And how big is the mortgage?
Oh, the mortgage is 2,000.
No, what's the amount, the balance due?
Oh, the amount left on the balance. Okay, I got you. I have 285 left. So the house appraises at 630.
Are you going to stay there?
Well, we don't need. So no, we haven't made up our mind. Let me say that it'd be, with all that happened in what was it, 2021, I believe, where everything escalated in price. I literally could sell the home and buy one smaller for cash.
Plan on it.
And the house that your mother lived in, are there other? Do you have other siblings? Are there other beneficiaries?
I have a brother. I have one brother, and the way we set it up is the house is still in her name, but when she passes, it automatically transfers to both of us, and I carry 51% of that.
And what's the value of that home?
It's not much. It's probably 74.
Yeah, you need a financial plan. What scared me most in this conversation is you said, based upon the economy in the next couple of years, we should be fine. That scared me.
Yeah.
And the reason is,
me too.
You're 65.
I did that
right?
on purpose. Yeah.
Because it really, you're like, whoa, because you have to operate your retirement independent of the economy. You have no control over the economy. You only have control over yourself and your investments and what you're going to spend and where you're going to live. You need a real fiduciary with a financial planning background to actually run these pro formas for you to say, okay, what happens when my wife's retire? When should she take Social Security? Will we be able to afford to stay in the house? My guess is that you won't be able to afford to stay in that house with a $2,000 a month payment on it. That would be my guess. But I don't know.
Unless he used a reverse mortgage, which is the second time I brought it up the show, which I don't talk about very often.
Yeah, but the house you said is too big anyway, so it wouldn't be my first. It wouldn't be my first place to go. You need a financial plan. You don't need the person that contacted you from back east. My guess it was the custodian for the 401k or someone involved with that. That would be my guess.
Well, actually, it was my manager had a guy who was doing his investment, so he turned me on to him.
But you don't need don't need an investment. To Pat's point, like your financial life has changed a lot in the last year or two, right? Dramatically, and you've decided to bring in your mom, which is a phenomenal. That's a wonderful thing to do. And with everything in life, good things in life, the great things in life cost a great deal, right? There's nothing wonderful in life that just drops in your lap. 99% of the time. Great things in life, great outcomes, takes work, dedication, all those things. Like, this is a labor of love that you're doing for your mother. There's obviously a cost in your daily freedom. There's a cost in your finances too. And I think it's important to kind of map all this stuff out. Let's lay it out. Mom lives another 10 years. Like, how do we cash flow all this? How do we cash flow it so that Larry and your wife can remain retired when your mom eventually passes on?
So people have a tendency to want to start with the investments, but we don't know. I mean, I could throw you a portfolio. I could do this, do that, but unless I actually know what the objective of the portfolio is.
And when's the chance we may need some of it? Because you might need more sooner than later.
Following. Mm-hmm.
So you need to find a good financial planner.
A certified financial planner. Someone could do a financial plan before we talk about, do we invest in this particular ETF or this annuity or whatever the investment product is. It's really based upon a financial plan, looking at the situation. Wife's retiring this fall. Your income is going to be dramatically different than it was when you were both working, and you've got your mother living here. What income does she have to help pay for the household expenses and her own personal expenses and all those other things, and map all that. And then we can say, okay, let's take the 401ks and the IRAs, let's put them in one type of portfolio. Let's invest it in these various investments, and let's have X dollars a month come into the household to help support, if that's what is needed on. But it's the financial plan that helps with that whole thing. So anyway, great talk with you. Great program, Pat. As usual, nice being here with you.
Yeah, I haven't seen you in a while.
certainly appreciate all our listeners. I hope you've enjoyed the program. Enjoy the rest of your week, and we'll see you next week.
This program has been brought to you by Allworth Financial, a registered investment advisory firm. Any ideas presented during this program are not intended to provide specific financial advice. You should consult your own financial advisor, tax consultant, or estate planning attorney to conduct your own due diligence.